Well, good morning. I am Jagender Rana. The topic for the discussion today is underwriting general insurance. Underwriting general insurance. So commonly, insurance is known as a social device in which a group of individuals, that is insured, transfers risk to another party, that is insurers, in order to combine loss experience, which permits a statistical prediction of losses and provides the payment of losses from funds contribute, that is premiums, by all members who transferred risk. So the insurers resort to underwriting, and underwriting is the process of classifying the potential insureds into the appropriate risk classification in order to charge the appropriate rate. Since insurance involves a large group of people or organizations who are exposed to similar risk, each person or the organization that becomes an insured to transfer the risk to the whole group, that is pooling of risk, as evidenced by an insurance contract issued by an insurer. For the systematic accumulation of funds through the statistical prediction of losses and calculation of premiums, and the payment of losses in accordance with the terms of insurance as a legal contract. So insurers therefore need to discriminate, that is classify, exposure according to expected loss. This gives the importance to underwriting of any risk. An underwriter decides whether or not to insure exposure on which applications for insurance are submitted. Again, if to insure the risk, under what terms, conditions, and whether loading or discounts are to be applied. So the distinct procedure of underwriting has to be understood. There are two separate procedures. One is group underwriting and second is individual underwriting. So for group underwriting, the group characteristics, demographics and past losses are judged because individual insurability is not examined. Even very sick people such as AIDS patients can obtain health insurance through a group policy in India and even in international parlance. Whereas for individual underwriting, the insured has to provide evidence of insurability in areas of health insurance or specific details about the property and automobiles in or property casualty lines of business. So an individual applicant for the health insurance must be approved by the health insurance company underwriter, a process that is specific to recognize the hazards associated with a person. Even for a person entering into health insurance after attaining the age of 50 years and above, with pre-acceptance medical checkup at their own cost for blood, urine, sugar, blood pressure, echocardiograph and eye check, including retinoscopy, all has now become mandatory. Then there is adverse selection. The most common risk of Indian general insurance underwriting is adverse selection. If the two groups of dissimilar risk exposures were charged, the same rate problem would arise. Basically, the rate should always reflect average loss cost. If we cover more number of perils, that is causes of losses, or more hazardous items, so the rate should increase. The insured, even knowing that they represent higher risk but always want to enjoy lower rates. This phenomenon of selecting an insurer that charges lower rate for a specific risk exposure is known as adverse selection, because the insureds know they represent higher risk but want to enjoy lower rates. So adverse selection occurs when insurance purchased for more often by people, organizations with higher than average expected losses. So that is insurance. That is, insurance is of greater use to insureds whose losses are expected to be high. So it is desired in underwriting that insurers may simply charge higher premiums to the insureds with higher expected losses. Here comes the problem of intense competition in this free market underwriting. Often, however, the insurer simply does not have enough information to be able to distinguish completely among insurers. Furthermore, the insurers want to aggregate in order to use the law of large numbers. Thus, some tension exists between limiting adverse selections and employing the law of large numbers. Now, the question is large base. Insurance organizations prefer to have a large number of similar units when ensuring possible loss exposure. The concept of mass and similarity are thus considered in underwriting. That is, before an insurer accepts a loss exposure, some insurance is sold on exposures that do not possess the requirement of mass and similarity. But such coverage is the exception, not the rule. An example of insurance on the legs of back end, a British football player, or on prize winning race horses when there are no masses of exposure. So the coverage is usually provided by specialty insurers. Lots of London is known for insuring such non-mass exposures as Bruce Springsteen's voice, but the major requirement for insurability is mass. That is free. That is, there must be large number of exposure units involved. For automobile insurance, there must be a large number of automobiles to insure. An automobile insurance company cannot insure a dozen automobiles. How large is a large group? For insurance purposes, the number of exposure units needed in a group depends upon the extent to which the insurer is willing to bear the risk of deviation from its expectations. Suppose the possibility of fire to houses is 1 upon 1,000. So an insurer might assume the risk for 1,000 houses with the expectation that one claim would be made during the year. If no fire occurred, there would be a 100% deviation from expectations. But such a deviation would create no burden for the insurer. But on the other hand, if two houses were burnt, the claims to be paid would be twice the expected number. This could be a severe burden for the insurer, assuming average by higher loss severity. So by increasing the number of similar houses insured to 10,000, the expected number of losses increases to 10. But the stability of experience is increased. That is, there is a proportionately smaller deviation from the expected losses than with a group of 1,000 houses. Then similarity. The loss exposure to be insured and those observed for calculating the probability distribution must have similarity. The exposures assumed by insurers are not identical in reality. No matter how carefully they may be selected, no two houses are identical, even though physically they may appear to be. They cannot have an identical location, and perhaps more importantly, they are occupied by different families. So, nevertheless, the units in a group must be reasonably similar in characteristics. If predictions concerning them are to be accurate. So, for example, house with bricks sidings bonded in cement are similar for insurance purposes, but the moment time the lime mortar is used as the bonding material makes lesser life for the building, but nothing will be visible from outside since all are plastered by sand cement mixtures. Moreover, probability distributions calculated on the basis of the observed experience must also involve units similar to one another. Then comes the measurement of possibility. The risk assumed by an insurer must involve only the possibility, not the certainty of loss to the insured losses. Must be accidental or fortuitous. So that is, they must be a matter of chance. Ideally, the insured should have no control or influence over the event to be insured. In fact, the situation prevails only with respect to limited situations. Tangible, physical, and also the intangible hazards influence the probability of loss. So, protection of potential losses is based on a probability distribution that has been estimated by observing past experience. The use of such estimates for predicting future losses is based on the assumption that future losses will also be a matter of chance. If this is not the case in reality, in line with the basic assumption, predictions cannot be accurate. In India, where there is a tremendous political and social turmoil, there is likely possibility of some adverse variations. Then catastrophic loss occurs. The possibility of catastrophic loss may make a loss occurred uninsurable. A catastrophic potential to an insurer is one that could imperil the insurer's solvency. When an insurer assumes a group of risk, it expects the group as a whole to experience some losses, but only a smaller percentage of the group members to suffer loss at any point of time. So, given this assumption, a relatively small contribution by each member of the group will be sufficient to pay all the losses. It is possible for a large percentage of all insurers to suffer a loss simultaneously. However, the relatively small contributions would not provide sufficient funds. Similarly, a single very large loss would also require large contributions. Thus, a requisite for insurability is that there must be no excessive possibility of catastrophe for the group as a whole. But there must be a limit that insurers can be reasonably sure that their losses would not exceed. Insurers build up surpluses, net worth, and contingency reserves. There is fund for future claims to take care of deviations of experience from the average, but such deviations must have practical limits. If losses cannot be predicted with reasonable accuracy and confidence, it is impossible to determine either insurance premium rates or the size of surplus required. Next one is definite losses. In property insurance, an accurate assessment of inherent hazards and the extent to which they are balanced by the safe design and operational safety management is of the key importance in understanding the risk and to provide an unbiased view to the insured. Losses must be definite in time, place, and amount because in many cases insurers promise to pay in huge amounts for losses if they occur during a particular time and in particular geographical area. For example, the contract may cover loss by fire at a specified location. So for this contract to be effective, it must be possible to determine when, where, and how much loss occurred. If this cannot be established, it is impossible to determine whether the loss is covered under the terms of the contract. The fact that pain and sufferings is hard to measure in money terms increases the insurer's risk when calculating rates for liability insurance. The next one is determinable probability distribution. For an exposure to loss to be insurable, the expected loss must be calculable. Ideally, this means that there is a determinable probability distribution for losses within a reasonable degree of accuracy. Insurance premium rates are based on predictions of the future which are expressed quantitatively as expected losses. So calculation of expected losses requires the use of estimated probability distributions. These probability distributions based on experience are useful for prediction. However, only when it is safe to assume that factors shaping events in the future will be similar to those of the past. And the last one is determining appropriate deductibles. For insurance to be economically feasible for any insured, the size of the possible loss must be significant, otherwise the purchase of insurance is not practical. Insurance is feasible only when the possible loss is large enough to be concerned to the person who needs to bear the burden. Again, the possible loss is always relatively large compared with the size of the premium. Of the losses the insurer pays plus the cost of insurer's operations are such that the premium must be very large in relation to the potential loss. Insurance is again not economically feasible. So when the expected loss premium is high relative to the maximum possible loss, internal budgeting of the risk is always preferable to insurance. So possibility of huge loss is normally transferred by the insured through insurance. Here comes the need for the use of deductibles potentially by the underwriters. The use of deductibles by the underwriters not only eliminates insurance reimbursements of frequent small losses but also helps make policies like motor own damage where automobile collision losses have high probability and the rest of certain damage too. great, the quantum of covering them would be very large compared with the size of actual loss. Thank you very much.